What's up, millennials? So I've heard more and more people talk about short sellers in the SPAC market right now. It seems that the amount of short interest has gone up a little bit in the SPAC market. And I've also received multiple questions about my current SPAC strategy because it has changed a little bit compared to a few months ago. So those are the two things that I'd like to talk about in this video. According to this article on Yahoo Finance, I found out that there were about 250 SPACs launched in the United States alone last year. And while usually, as we have seen during the SPAC valuation videos, each SPAC is usually valued between something like 1 billion and 3 billion more or less. Or some companies are a little bit cheaper, some companies are a little bit more expensive, but I think like the general range is between like $1 and $3 billion. So I believe, I'm not entirely sure anymore, but I believe there was about $800 billion raised in SPACs last year. As we can see also in this article from Yahoo Finance, we can see that the short interest has gone up as well. We see that it has gone from $724 million to $2.7 billion. So that's a little bit more than 3x, of course. But I think that 2.7 billion, it might sound a lot, but I do kind of think that it is not that much if you take into account that there is about $800 billion raised in SPACs last year. So yeah, I'm not entirely sure what the percentage is. I think in general the percentage of short interest is relatively low, but of course there are some exceptions. One of those exceptions is IPOE, so the IPOE stock that is going to merge with social finance, so SoFi. This, of course, is a Chamath Palihapitiya's SPAC, and there, according to this article, is already 19% short interest. If you look at the CCIV, of course, merging with Lucid Motors, 5%. Excel Fleet, I don't think they mentioned the percentages, but it's going to be a little bit higher as well because they received a short seller report from Muddy Waters, and also the company Lordstown Motors, so the company that is currently trading under the ticker symbol RIDE, also had a, I believe from Hindenburg. Yeah, from Hindenburg, they also received a short seller report. So yeah, in some SPACs, of course, the amount of short selling is increasing right now. And all of this short selling probably has led to a little bit of a sell-off in the SPAC market in general. I think there are multiple factors, but I think short selling could definitely be one of them. And that has led to multiple SPACs, like in this list that I have on TradingView, you can see multiple SPACs being very close to that net asset value of $10 per share. Because usually what happens with a SPAC, almost all SPACs start trading at $10 per share. And before the SPAC actually closes the merger, you can redeem your shares for $10 per share. So usually the floor, if you will, is about $10 per share. Now keep in mind, this redemption period is not for always. It's not going to be there always. It is going to end at some point. I believe usually what happens is that 2 business days before the merger vote occurs, the redemption period is over and you cannot redeem your shares for $10 anymore. So yeah, one of the examples we saw was View, of course. They had already been trading below that $10 before the merger actually closed. And right now the merger just closed a few days ago, last week, I believe. And the current price of View is $8.61. So there is definitely a possibility that the SPAC can go lower versus that $10 level. The floor of $10 is not always going to be there. So keep that in mind. Now, if you know me a little bit, you probably know that I do a lot of SPAC valuation videos, and I'll say a little bit about that. But before I do so, I'd like to also talk about my Discord, because if you want to have access to the Excel sheet that I use during these SPAC valuation videos, or if you want to have access to some additional resources, you can simply join it for free. You can just go to nesami.com/discord. You can then leave your name, leave your email address, and then you're going to have access to this Discord channel over here. If you then go to the SPACs channel, and again, this is for free. If you go to the SPACs channel, you can go to the pinned messages, and there you're going to find, first of all, the full SPAC guide. So I made a 1-hour long video in which I explain how I go through these SPAC valuations from step 1 to the last step. And then you're also going to have access to the Excel sheet that I use for all these SPAC valuations. So you can just plug in a few numbers to have a SPAC valuation very, very quickly, within a few minutes usually, and also a list of all these SPAC valuations that I've done so far. Now, one thing I wanted to make clear in this video is something that has to do with these SPAC valuations, because I'm doing quite a lot of them, and well, usually when I say a stock is undervalued, people are very happy, and when I say a stock is overvalued, or when I think a stock is overvalued, then people get quite upset. And I completely understand that, but my goal is not to have you follow me what I say entirely, but what I want is that you use the knowledge that you gather within my videos, but also the videos from other people, and you apply that knowledge yourself using the tools that I provide you, that, I don't know, Meet Kevin provides you, Graham Stephan provides you anyways. Yeah, just apply that knowledge in your own way. Just don't follow everything that I say, because I'm just not a financial expert. I'm not a guy who knows everything, right? And especially I'm doing so many of these SPAC valuation videos, I'm not going to be able to do a deep dive on every single SPAC. I've probably done like 30, 40 SPAC valuation videos. I'm not able, I just don't have the time to go through all of these SPACs very, very deeply. One example of one of these videos that I did was about the SPAC VACQ, which is going to merge with Rocket Lab, and I've received many comments that were like, well, this range of multiples isn't fair, and I completely understand that, and my research was, of course, very superficial. I just went through a few forums to see what kind of things people were saying. I did a very superficial research to come up with my own interpretation of the valuation, to come up with my own range of multiples that I believed to be fair. But of course, if you do not agree with that, if you think another range of multiples is fair, then just go ahead, use the sheet, use your own multiples to come up with a different valuation. Because all of these, what I do is simply interpret the data that I see. I could be completely wrong, as I say in basically all my SPAC valuation videos, because I'm just not going into all of these companies very deeply. So again, that is not the goal. It's not the goal that people follow me. It's basically the goal that people understand my method, that they potentially use the same strategy or not, but hopefully they learn something from it, and then they can use their own multiples, their own interpretations of the data to come up with a fair valuation. So what I used to do was mainly look at the valuations that I've done and simply pick the most undervalued ones. So for example, yeah, CFII, NPA, Romeo, of course, FTOC, all of these seemed very undervalued and seemed to be very attractive to me. But I'm kind of changing my strategy right now, because many of these SPACs just don't really have any revenue for years and years on end. Companies like NPA, which is going to merge with AST Space Mobile, this company just doesn't have a revenue for years. So it's very, very risky to get into a SPAC like this one. I did initiate a swing trade, but I'm not going to hold this for the longer term. And the thing is that these kind of companies just don't really have a proven track record just yet. They need like years and years of experience to be able to prove that they're actually able to achieve the goals they set out in their investor presentation. Another thing to take into account is that many of my SPAC valuations are based on future performance, just like the case with MPA merging with AST Space Mobile. That is based on, I believe, the revenue or maybe the EBITDA of 2025 or maybe even 2026. So the thing is, this is based on a future of 5 years ahead. We just don't know if they're actually going to meet their revenue goals, if they're going to meet their EBITDA goals. So we can of course make valuations based on these numbers, but we're not even sure if these are actually goals that are going to be achieved in the long term. And also another important factor is the amount of cash they have on their balance sheet. Because especially in cases like NPA merging with AST Space Mobile, if they don't have revenue for years, that means they're going to have to burn through a lot of cash. They might right now have like $500 million in cash, or maybe even more, I'm not entirely sure. But after a few years, they're probably going to have no more cash, because they're going to have to simply pay employees or create products, create a facility, right? So they're going to burn through a lot of cash, probably hundreds of millions each year, and they're likely even going to have to raise additional cash in the future to simply keep the business alive. Plus, keep in mind there have been a lot of EV SPACs, especially in 2020. We've seen many EV SPACs. And the thing is, not all of these companies are going to win. I don't think all of these companies are going to achieve their goals. Because the thing is, you cannot have 50 Teslas, 40 Apples, 30 Zooms. I think the situation is going to be that the winner takes most. There are going to be a handful of companies that are going to do very well compared to the rest that are going to do not so well. So what am I doing right now? Well, I'm kind of moving from a risky strategy to a little bit safer strategy with regards to SPACs. In general, my portfolio is very much focused on high growth stocks, but I kind of want to move away from companies like NPA or swing trades like NPA, because it is a swing trade for me. And I want to go to more safer SPACs. What does that mean exactly in my case? Well, I want to search for SPACs that have solid revenue already, that have a proven track record, and also companies in which I have a lot of conviction in either the product or the company or the team behind them. One example is BFT, which is going to merge with Paysafe. I think they already have a very solid amount of revenue. They already have that proven track record I was just mentioning, and they're also working in digital payments for gaming, which is a little bit of a niche, and I like that as well, investing in companies that are very big in one certain niche. I don't think many companies are actually doing that. Another SPAC I just picked up last week is FRX merging with Beachbody. They also have that solid revenue. They also have that proven track record. They, of course, compete with a company like Peloton, which is huge, but I do like the social media aspect of the Beachbody, that they're using influencers to promote the products. And yeah, again, not many companies are doing that either. So I think in general you can say that I'm kind of looking for the unicorns within the SPAC world, that I want to have the SPAC to have a good amount of revenue, proven track record, preferably a leader within a certain niche, not just one of many companies, and preferably also a strong leader, a strong team. So that's what I'm doing. That's how I am changing my current SPAC strategy. I'm selling out of low conviction SPACs and I'm moving more into high conviction SPACs. And of course, I alert my Discord Premium members when I do so. Now I'd like to hear from you as well. Are you also changing your SPAC strategy? And if so, what are you changing exactly in your strategy? What is the thing that you are looking for in a SPAC? With that being said, thank you very much for taking the time to watch this video, and to hope to see you in the next one. Bye bye!